Hello friends, this is your host Rakesh Kumar. In the previous video, we had seen some live examples of the double top pattern, and in this video, we are going to discuss the next pattern, which is just exactly opposite of the double top, and the name of the pattern is the double bottom. We will see how and when this pattern emerges and what is the psychology behind the pattern. But before we begin, let us have a look at the risk disclaimer. It states that the futures, stocks and the options trading involve substantial amount of risk. Your capital is at risk. The losses can exceed the investment. The information is provided as is, and the user of the information assumes the entire risk of any use it may make or permit to be made. So let's get started. Okay friends, to begin with, we need to know what all are the requirements for a double bottom to be a valid double bottom pattern. First of all, it should have an extended down move. There is a need of extended down move. Okay, as I bring all these requirements, I will also draw it here. You have already seen the double top pattern. Now we are discussing the double bottom. In the double top, we had an extended up move, and in the double bottom we had an extended down move. Okay, we have an extended down move, and after that we have the need of a low. Okay, so we have a low here. We will mark it as low. This will be our first low, so we will mark it low 1. Okay, so this is our low, first low, and from this low we need a reaction high. First we need to have an extended down move, then we need to have a low, and then we need a reaction high. And in the chart I will show you that we need to have a reaction high. From this reaction high cannot go higher than the previous highs that it had made. Okay, so this is a reaction high. A reaction high is a small reaction to the low that price has just made. And after the reaction high, we need, then there is a need of another low to the level of previous low. Now here the previous low was this, so almost we need a low to almost this same level. Okay, so say that the price from here dropped back to this place again. Okay, like this. So we have another low here in place. Now we will name it as low 2. Okay, now we have a second low. After that we need to break reaction high, so there's a need to break reaction high. Now reaction high is here. A break will be, the meaning of the break means the price goes higher than this. From here the price must go higher than this, and at the last we need a confirmation candle, or a candle which closes higher than the reaction high. So the pattern is confirmed only after the candle closes above the reaction high. So I hope you got it. If the candle touches this high, we don't enter a position, or the pattern is not confirmed. We are still in the formation of the pattern, but the pattern is confirmed only when the candle closes higher than this place. Okay, so all in all, if you compare it with this one, here we had an extended up move, in this one we had an extended down move, here we had a high, here we have a low, here we had a reaction low, here we have a reaction high. Okay, I can simply clone it and keep it here and edit it as reaction high. So that makes sense. So we have here a reaction high, and we need another low after that, as we needed another high here, and after that after that high too, we needed a close below reaction low. Here we need a close higher than the reaction high, but we will not enter the market at this close. Like here we had did not enter here, but we waited for the market to come back to this support now, which will have turned as a resistance to give us another opportunity to enter this market. Okay, and this will also make our stop loss, which would be somewhere here, as a very small stop loss, and take profit target will be equal to the height of the pattern. Here also the take profit targets will be approximately equal to the height of the pattern, which in this case is approximately this one. So we will, from the break, we will measure this height, and this will be our target. This will be our target. So I will mention them again. This is target, okay, and we won't be entering like this, but we will be entering at the retest of this as a new support. Okay, so this will be our this will be our next support, and we will enter at the test of this resistance as the new support. So this will give us a target equal to this height of the pattern. I hope I have made myself clear in this part. And as I had also told that we will be discussing what is the psychology behind the market, I will try to explain. Suppose there is a downfall of any asset, let it be any instrument, it can be a commodity, it can be a currency, it can be anything. Okay, suppose something is going down and down. This means that the sellers are very eager to sell their positions, and while selling, the buyers find that now, okay, this is the place where it is at a cheaper position, so I should start buying. So they start buying, pushing the price higher. So this is a continuous tug of war between the buyers and sellers. What is the price? It is a continuous tug of war between the buyers and the sellers. If the sellers are if the sellers are in control, they push the price down, and if the buyers are in control, they push the price up. So from here, when there is a reversal, or we create a low, when there is a reversal, so the buyers are in control of market, but for a very less amount of time. They are not able to push the price above the previous highs, which were here somewhere. So this is called a reaction high. This was the reaction of the buyers, which are still not in the complete control of the market. So sellers again came in to push the buyers down, and they could not push the buyers much down than the previous time they could do it. Now if this low, this second low formed here, is higher than the previous low, slightly higher, then it is a very good signal that the sellers could not push the buyers much below the previous low. Okay, but sometimes 2 to 3% of the previous low is okay. It can be taken into account for the completion of a double bottom. Okay, so when the price goes here, the buyers who came in here, they jump again, and this time if they are able to break above the reaction high, this means that now those who were selling their positions from these points, they again tried to enter the market at these points, but the buyers have made their stop losses to trigger, because of course somebody selling here, they must have the stop losses here. Buyers force the stop losses to trigger higher by closing a candle higher than this. Now this means that now buyers are in the control of the market. So those who missed the boat at these levels, when all these buyers were buying, so those who have missed the train or boat at this level, they will try to enter the market again at the test of this level, which happens. Okay, most of the time it happens. So essentially we have to board this boat when it tests this level, and we see some bullish pin bar here, or bullish engulfing candle here on whatever the time frame we are talking about in this pattern. Okay, so this is the best place. This is the best place to enter the market. This is the best time to enter the market because your stop loss is very small, your take profit is huge. Most of the time you get 1:4 or 1:5 risk to reward ratio in this type of trading, and I really love this pattern to trade. So I hope you got the idea, and in the next video we'll try and tell you some do's and don'ts about this pattern so that your money is safe. I want you to have some green pips. Thank you very much for watching this video. Hope to see you soon in the next video. Thank you very much.